Welcome traders, Maciej here from Taurus Trading. In this video you will learn how to use moving average as a trend filter, so stay tuned. Technical analysis represents a methodology of forecasting the future price movements through the study of past price data and uncovering some regularities or patterns in price dynamics. One of the basic principles of technical analysis is that prices move in trends. Analysts firmly believe that these trends can be identified in a timely manner and used to generate profits and limit losses. Consequently, trend following is the most widespread market timing strategy. It tries to jump on the trend and ride it. Specifically, when stock prices are trending upward, it's time to buy, and when they're trending downward, it's time to sell the stock. Even though trend following is very simple in concept, its practical realization is complicated. One of the major difficulties is that stock prices fluctuate wildly due to imbalances between supply and demand, and due to constant arrival of new information about company fundamentals. These up and down fluctuations make it hard to identify turning points in a trend. Moving averages are used to smooth the stock price in order to highlight the underlying trend. Any moving average of prices is calculated using a fixed size data window that is rolled through time. The length of this window of data, also called the averaging period or the lookback period in a trailing moving average, is the time interval over which the moving average is computed. The profitability of a trend following strategy is based on the ability of early recognition of turning points in the stock price trend. However, since the stock price is noisy, this noise makes it very difficult to see the trend and turning points in the trend. To remove the noise, analysts use trailing moving averages. These moving averages have the following two properties. First, the longer the size of the averaging window, the better a moving averages remove the noise in the stock prices. At the same time, the longer the size of the averaging window, the longer the lag time between a turning point in an intrinsic stock price trend and the respective turning point in a moving average. It is important to keep in mind that a turning point in a trend is identified with a delay. If analysts want to shorten the delay, they need to use a moving average with a shorter window size. Since moving averages with shorter windows remove the noise less effectively, using shorter windows leads to identification of many false turning points in the stock price trend. Increasing the size of the averaging window improves the precision of the turning point identification. At the same time, longer averaging windows increase the delay time in recognizing the turning points in the stock price trend. Therefore, the choice of the optimal size of the averaging window is crucial to the success of a trend-following strategy. This choice needs to provide the optimal trade-off between the lag time and the precision in the detection of true turning points in a trend. It is worth emphasizing that since a trend is recognized with some delay, the success of a trend-following strategy also depends on the duration of a trend. That is, the duration of a trend should be long enough to make the trend-following strategy profitable. At each current time, the value of the moving average of prices generally differs from the last closing price. When stock prices are trending upward, the moving average lies below the price. In contrast, when stock prices are trending downward, the moving average lies above the price. On average, the difference between the value of the moving average and the last closing price equals the average lag time times the average price change. Only when the prices are trending sideways, that is, they stay on about the same level, the value of the moving average is close to the last closing price. If prices are trending steadily upward or downward, all moving averages with the same average lag time move largely together regardless of their shapes of their weighting functions and the sizes of their averaging windows. Moving averages that overweight the most recent prices provide a better trade-off between the smoothness and the delay in the turning point identification than that provided by the moving averages with equal weighting of prices. For the same degree of smoothness, linear moving average has smaller lag time in turning point detection than that of simple moving average. Exponential moving average has the best trade-off between the smoothness and the delay in the turning point identification. Therefore, linear moving average and exponential moving average have some potential advantages over simple moving averages. However, these advantages might be marginal and do not translate into significant differences in practical applications. Basic implementations of long-only trend following exhibit considerable robustness and consistency over the long run when applied to US equities. The short run, however, is a different story. From this slide, we can see that if we were about to implement very simple trend following strategy to US equities, which is based on a 12-month look-back period, we would achieve a 400% return in 50 years. Returns for this strategy are normalized, which means that you can see how much will $1 grow in almost 50 years of trading this type of strategy. While simple implementations can help ensure that we avoid overfitting our models to historical data, it can also leave us exposed to a number of unintended bets and uncompensated risks. Instead of adding more complexity, I believe that the simple solution to combat this risk is diversification. While trend following worked well on US equities, the approach had less consistency when applied to international indices. Instead of presuming that the US represents a unique candidate for this type of strategy, I have explored a sector-based implementation that may allow for greater internal diversification. So from this example, we can see that only by changing a sector we're about to invest in, we can generate very different returns. The time period for this backtest is longer than the previous ones. It has almost 90 years of data. We can see that $1 invested in utilities or health sector will produce much better returns than, for example, $1 invested in an energy sector. There are a variety of approaches practitioners use to measure and identify trends, and each comes with its own pros and cons. I have explored 4 popular methods and I have found that none consistently reigns supreme, indicating once again that diversification of process is likely a better approach. Similarly, when it comes to optimizing these models, I have found a range of look-back periods are successful in the long run but have varying performance in the short run. By looking on this graph, we can see that, for example, last 50 years of trading this type of trend following strategy, we would have 5% on average difference between the variety of look-back periods. Similarly, if we were about to apply momentum strategy instead of moving averages, again we can see almost a 5% difference on average depending on the time series horizon ranging from 6 to 12 months. These charts comes from Valery Zakemulin's study made in 2016, and as you can see, he backtested a data going back all the way to 1890, I believe, so more than 100 years of data. And in the top left corner we can see the performance of a momentum strategy. On the right top corner we have a price minus exponential moving average. In the left bottom corner it's simple moving average strategy, and its performance, and in the right bottom corner it's a double cross of two moving averages. The results are very similar for all of these strategies, so we can clearly see that it's virtually impossible to optimize for one lookback period which would perform well over the long run. Since this video is mainly about moving averages, let's look at the left corner bottom of the chart where we have results for a simple moving average strategy. Just so you know the way it's done, Valery Zakemolin, the author of this scientific paper, he would take a look at the last 10 years of performance of the very strategy, and he would optimize for the best lookback period. So as we can see with the simple moving average, the range of the best lookback period varies from 25, this is in months, so from 25 months to 1 or 2 months in some examples. A lot of studies in this subject recommend using a range of lookback periods ranging from 6 to 12 months, and to use the one with the best historical performance for the portfolio of futures on commodities. A trend filter can be used in order to make sure the trend following methods only signals for a long or short position when there is a clear trend in the market, thus better avoiding the periods where the market moves sideways or even in the opposite direction. The biggest problem with using simple moving average as an indicator is that a pure moving average strategy will always be in the market even if there is no clear trend. This may be the most common case because the time series may just be mean reverting for a long period of time. When the market is moving sideways, the moving average strategy will be entering and closing position on a short-term basis, losing on most of these trades. A trend filter will stop it from entering into trades when there is no significant trend to profit from. The simple moving average is in itself a trend filter, just not a very good one on its own. By adding a second trend indicator as a trend filter, the performance may be improved by the elimination of short-term trades. The breakout strategy would also benefit greatly from a simple trend filter. It does not have the same problem as the simple moving average, as it is not always in the market just after a price breakout, but because it enters into a position when the time series had its lowest or highest value in the past X data points, it sometimes has the tendency to do so when the main market trend is moving in the opposite direction because of a pullback in the market. A pullback is fairly common after a strong market trend and is usually not a good time to enter into a position. So the time series may have its lowest or highest value in the past X trading days, but at the same time, the main trend is moving in the opposite direction of the breakout signal. For example, the strategy will signal for a long position during a strong bear market, resulting in overtrading and taking long and short positions back and forth with overall losses. The remedy for this is to use a second trend indicator as a trend filter. The easiest one to use is a combination of two simple moving averages as the trend filter, one with a short lookback period and the other with a much longer one. A breakout is now only allowed if its signaled trend is moving in the dominant market trend direction. The two mixed simple moving averages are not used as a trend signal, but rather as a filter for when the market's general direction does not coincide with the breakout signal. When the faster changing short-term simple moving average, faster due to the lower lag, crosses over and as long as it's above the slowly changing long-term simple moving average, it is an indication for that the price series of the instrument is changing upwards due to the recent event. This is because the short-term simple moving average is better at catching recent changes in the time series than the long-term one because of the smaller lag. Consequently, when the faster changing simple moving average is below the slower changing simple moving average, it is an indication for that the price series of the instrument is changing downwards due to recent event. Both standard deviation and average true range are tools used to measure the historical volatility for a stock or an index over a fixed period of time. They are sometimes used interchangeably, but they are two different tools, and average true range is by some considered the better choice, mostly because it encompasses more information and better reflects the historical price movements due to the fact that it, apart from closing prices, also take highest and the lowest prices into consideration. Average true range was introduced by Wilder in 1978 and had since then been widely used in trading system as an alternative to standard deviation to measure the historical volatility of a financial asset. The argument goes that volatility is directly proportional to range and that range is equal to the distance the price moves per increment of time. In example, the difference between the highest and the lowest price for a specific time frame. But more than one day's range must be considered for any given trading day due to the fact that price series are not continuous and price levels are limited by the closing and opening price. The range takes intraday volatility into consideration without having exact data for intraday volatility, since this is generally not available for historical simulation. Therefore, the true range is defined as the greatest value of the following three distances: the distance between today's high and low, the distance between yesterday's closing price and today's high, the distance between yesterday's closing price and today's low. The fundamental concept of the core strategy, introduced by Andreas Klinow in 2013, is to first identify a possible trend, upward or downward trending, and hold the position as long as the trend is not wearing off. The idea is not to hit the absolute high and low of the time series, but rather capitalize on the overall trend movement. This strategy will signal for entering and closing a position in an instrument, and the strategy is as follows. Long entries are only allowed when the 50-day simple moving average is above the slower changing 100-day simple moving average. This is the first part of the trend filter. Short entries are only allowed when the 50-day simple moving average is below the slower changing 100-day simple moving average. This is the second part of the trend filter. If there is no position already in the instrument and a long position is allowed by the trend filter, a 50-day breakout of the closing prices will signal for either buying or selling instrument. In example, if the present closing price is the highest in 50 trading days, a certain number of contracts in that instrument corresponding to the position size determined by the portfolio allocation method are bought on the next day's opening price. Consequently, if the closing price is the lowest in the 50 trading days, that amount of contracts are sold. A long position is closed when the closing price for the instrument is 3 ATR units below the highest closing price the instrument has had since the positions was taken. So for example, if you are trading S&P 500 and the ATR read of the last 14 days is 20 points, that means that your 3 times ATR is 60 points, and that's how much you will be trailing your stop behind the recent price. A short position is closed when the closing price for the instrument is 3 ATR units above the lowest closing price the instrument has had since the position was taken. So for example, if you are trading gold and you look at the ATR and it shows that for the last 14 days the average true range was around $15, that means that 3 times ATR unit is $45, and that's how much above the recent price you will be trailing your stop. In this video you have learned how to use moving averages as a trend filter so you don't get stopped out back and forth using only one moving average. By the way, the so-called core strategy, which has been described in full detail by Andreas Klinow in his 2013 book, has also been a basic for replicating the most successful hedge funds. The only difference is how much capital was allocated per particular instrument that you were trading. So in his book, Andreas Klinow have proved beyond any doubt that most of the very successful funds have been very heavily invested in a fixed income sector as well as equities, less in commodities and forex. If you are new to this channel, please consider subscribing. This way you won't miss any new videos that are already in the works. Also, you might as well want to visit my website and grab a free copy of ebook that I've prepared about financial markets, and I hope to talk to you soon.